Well, I'm Ron DeLegge with ETF Guide, and it's great to see you. One of the biggest problems facing 401k investors and those that are planning for retirement is not having the ability to protect their retirement assets, especially in markets that are choppy or declining. And so ETFK Retire is a new type of 401k plan that appeals to investors that want to protect their retirement savings. And so we're going to talk a little bit about rocky financial markets on today's program. I've got a guest that I'm going to introduce in a second. And ETFK.com is where you go to get your 401k plan started using all ETFs. Now, we're just going to talk in this particular episode about one specific solution, which deals with protecting your capital and also having some upside potential with buffered ETFs. And so that's what we're going to talk about. We've got as a guest Greg Moerchen with QBOX. Greg, great to see you.
No, thanks, Ron. I'm happy to join.
Yeah, so I'm going to ask for your help, Greg, as we go through some of these slides and kind of talk about the basics with buffered ETFs. I know you've successfully been using buffered ETFs in a retirement setting for a number of years. And of course, we're also using that in the ETFK retirement solution. What is it that you like about buffered ETFs, Greg?
Yeah, Ron. The big thing is that when you have a volatility like right now, markets go up and down, and what these buffer products do is it minimizes the down, and it also puts a cap on the upside. But again, minimizing that downturn and still keeping your toe in the water, so to speak, is where these buffer products really shine.
Yeah, absolutely. So why use buffered ETFs? What are some of the potential benefits and purpose of these types of ETFs? What do we see here?
Well, the big benefit is, again, absorbing downside up to a certain percentage. And as everyone knows with basic math, if your account goes down 20%, it takes more than 20% to make that back up. Or the other issue that we run into is that people are getting close to retirement and they just don't want to see their account fluctuate like it did when they were, much younger, and they had plenty of time for it to, recover during market phases. So this is where buffered products are just a perfect match for a qualified plan setting.
Yeah, and I think a lot of retirees, honestly, are actually okay with limiting their upside in exchange for protecting their downside. Because honestly, nobody wants to be in retirement and completely wiped out.
I would totally agree with that, Ron. Yeah.
So let's take a look at an example of how this might work. And really, when we think about buffered ETFs, it's just creating a tighter range of potential outcomes. Now, none of us can predict, obviously, what the market's going to do tomorrow or next week or next month or next year. But these products, these solutions within a 401k setting, as we're doing at etfk.com, allows the retirement saver, the 401k investor, to just have a little bit more clarity and a little bit more understanding of what they can expect. Less surprises, so to speak. So in this example, we've got three different kinds of markets. We've got a deep bear market, a strong up market, and then we've got kind of a flat market. And you can see that illustrated here in the aqua green at the very top. Deep bear market, anything that's worse than a 20% decline is generally defined as a bear market. So we could see how a buffered ETF might do in that type of environment. So we've got two types of buffered ETFs in this example. We've got one with a hypothetical 16% upside cap with a 12% downside buffer. That's this first, or I should say second line on the table. And then just below that is a buffered ETF with a lower upside cap of 13% and then a higher downside buffer of 20%. And you can see in a severe or deep bear market, the buffered ETF solution that has a higher buffer, right, is going to protect you more, right? Buffer,
Right.
When we talk buffer, maybe you can explain this to our audience, Greg. What does that mean?
Yeah, so the best example I can give you is that pretend that this is the day that you open up your statement. You haven't looked at one in 5 years, and you thought you had $100,000 in your account, and now the market is down 30%. So your $100,000 all of a sudden is now 70,000 on your statement.
Yikes.
So yeah, so let's pretend you use the buffer that had the 16% or was down 18%. So now you're down 18,000 instead of 30. And the third option there, you were down $10,000 as opposed to 30,000. So to put that in real dollars, you know, everyone's happy when the markets go up. It's just that when you go down, that's when you question if you have the right risk tolerance, for your situation. And again, this is a great way to paint your expectations that if you're not comfortable with your account being down $30,000, there are other options, and that's what we've constructed, within ETFK, so that we can fit that, we can minimize that downside that could happen with your account.
Yeah, exactly. And this gets to what you were saying all the way to the right where it says return range. You'll notice when there's no protection in a portfolio, you see the return range can swing wildly, 60% in this example. Whereas when you start using the buffered ETFs, now we can begin to kind of tighten that range of potential outcomes and reduce the amount of shock or potential surprises.
Yeah, correct. And again, that's the best way to think of it, is that we basically just move the jaws closer together so that your downs aren't as deep and your ups aren't as high, but it's made itself very, very consistent based on what your risk tolerance is.
Excellent.
Yeah.
Now, this kind of explains a little bit further in a different way, kind of like how that works with the interaction between the upside cap and the downside buffer is. So can you kind of maybe take us through that, Greg, how that works?
Yeah. So what's really nice about the buffer products are that there's not someone behind a black curtain making decisions on what to buy or what to sell. These products all use what are called option contracts that have a specific expiration date. So it's if during whatever the time period is that they're covering, typically it's 12 months. If the market goes down, then the option contracts kick in and they're going to absorb that loss. So again, there's not someone making that decision of what to buy or what to sell during that 12-month time period. And then on the flip side, again, they have option contracts that kind of pin in that cap that could happen. So again, they work really, really well because again, you're taking out the market timing, basically to have some sort of hedge in place, and these buffer products work perfectly for that as a hedge. So
yeah, and as you can see here, the investor with that cap will not experience anything above that cap in terms of upside performance. However, these are designed that investors can experience potential gains up to that cap, that ceiling, that limit. And then same thing applies on the downside with the buffer. The investor does not experience losses up to the buffer, but once losses exceed the buffer, then there is the potential for losses. So these, again, are the types of solutions that we use inside ETFK Retire, solving a real-world problem for 401k investors, protecting your money in all kinds of markets, not just markets that are bad, but even choppy markets that are volatile, and everything in between. And so, Greg, great job. Thank you so much
Thanks
for taking the time. And we're going to talk in another episode a little bit more at length about the exact way that you're deploying these buffered ETF solutions. How about it?
Great. Sounds good, Ron. Looking forward to it.
Be sure to go to etfk.com to get your ETFK plan started. There's lots of good information there. I'm Ron DeLegge with ETF Guide. We'll see you on the next episode. Thanks for watching.